ECB Başkanı uyarıyor, bankalardan, Fintech ve Kripto'dan gelen riskler devam ediyor.
Thank you very much, Connie, and good morning to all of you, and welcome to the 9th annual conference of the European Systemic Risk Board, the ESRB. I hope you all had a good summer. As to me, I did my fair share of scuba diving. And what I would like to do, if you allow me, is to take you underwater. So imagine you're embarking on a submarine. Submarines rely on sonar to navigate unseen depth and detect hidden dangers. For anyone who's been underwater, you would know that the oceans are never silent. It is filled with shifting currents, marine life, the sounds of dolphins and whales, and more so now, human noise. And in some waters, that background noise has doubled every decade for the past 60 years, making it harder to pick out the signals that really matter. But no matter how unfamiliar the waters are, the technical principles remain the same. Those trained to listen can always discern the echoes of the real danger. Why did I take you on this submarine? Because if you think about it, it is the same with our financial system. We too are navigating waters where the currents are shifting rapidly. Geopolitical fragmentation, climate change, rapid digital innovation are reshaping finance flows, where it flows, and what channels it takes. The noise is getting louder and the landscape more complex, but the echoes of risk remain familiar. Our task, like that of the submariners, is to listen carefully and to separate signal from noise. However much the structures of finance may change, the patterns of risk endure. And as Charles Kindleberger reminded us, I quote, "Financial crises are a hardy perennial." By recognizing the recurring signals, we can keep such crises in check and preserve stability. So today what I would like to reflect on is how we can safeguard financial stability in a changing system by cutting through the noise to recognize the risks that endure. This task has become ever more demanding now. In the past, when Europe's financial system was dominated by banks, detecting risks often meant closely reading banks' balance sheets. That world has changed. Europe's non-bank financial sector has expanded rapidly. In relative terms, it is now larger than that of the United States, amounting to 3.8 times GDP of Europe, compared to 3.1 times that of the United States. And at the same time, banks' activities are intertwined with those entities and increasingly with new entrants such as the Fintech platforms. The line between banks and non-banks financial institutions has blurred to the point where the old conceptual distinction is no longer a useful guide. So how do we cut through the noise created by this new complexity? Two constant factors will help us. The first is that financial activities, however novel their appearance, no matter what the clothing, are almost always variations of the same few timeless functions: transforming maturity, transacting, saving and borrowing, investing and sharing risks, insuring and hedging. Likewise, the risks that arise from these functions, namely credit, market, liquidity, underwriting and operational risks, are equally enduring. And we know from experience that the tools to contain them remain familiar: capital and liquidity buffers, reliable data, and secure transaction. The second constant is the framework of sound risk management and supervision. These principles endure best when they are set globally. And this is why banks remain governed by global standards developed by the Basel Committee, and why the FSB, the Financial Stability Board, is extending that framework to new financial activities. This does not mean a reluctance to adapt to new realities. On the contrary, it is about using a stable framework for regulators and supervisors to cut through the noise and to hear the signals. And this is why the ESRB has argued for an activity-based and system-wide approach to financial stability, by looking through the outer shell, the clothing, of both traditional and novel financial entities. We can assess the activities and risks that truly matter. And by viewing the system as a whole rather than as a collection of individual firms, we can better understand how risks propagate across these institutions. Now, how does this perspective apply to the new financial entities that are emerging across the financial landscape? Take the crypto asset sector. For example, stablecoins. Stablecoins are issued with the promise of maintaining a stable value against a reference asset. For now, they are used primarily as a bridge to and from the crypto ecosystem and as a tool to facilitate crypto asset trading. But they also aspire to take on more traditional functions, such as serving as a means of exchange. At first sight, these entities, new name, new clothing, new characters, and these activities may seem novel. But we do not need to wait for them to mature to realize that they are reintroducing old risks under new clothes through the back door. The categories of risk they create are not new. They are risks long familiar to supervisors and regulators. The most obvious one is liquidity risk. We know the challenges posed by institutions that invest in risky assets, while at the same time promising investors redemption at short notice and at par. Such entities must mitigate the risks of a run by ensuring that they have sufficient liquidity to meet redemption swiftly. And this is why the ESRB has been sounding the alarm on certain types of money market funds, for example. In the case of stablecoins, the EU's Markets on Crypto Assets regulation, well known as MiCAR, seeks to address this risk in two ways. First, stablecoin issuers must allow EU investors to always redeem their holding at par value. Second, stablecoin issuers must hold a substantial share of reserves in bank deposit. But gaps remain. One example is so-called multi-issuance schemes, where an EU entity and a non-EU entity jointly issue fungible stablecoins. Fungibility not being particularly well defined, if I may say. In such cases, MiCAR requirements do not extend to the non-EU issuers. Jurisdiction is EU, not the long arm. And in the event of a run, investors would naturally prefer to redeem in the jurisdiction where there is the strongest safeguards, which is likely to be the EU, where MiCAR also prohibits redemption fees. Not the case under the Genius Act, for instance. But the reserves held in the EU may not be sufficient to meet such concentrated demand. The risk of liquidity mismanagement across jurisdictions is one that many of you are familiar with because we've seen it before. Banking groups, for example, are already required to ensure that reserves are available in the part of the group where and when they are needed. And this is why requirements such as the net stable funding ratio and liquidity coverage ratio apply at every level of consolidation. Multi-issuance schemes replicate these very same risks with a single entity. We know the dangers, and we do not need to wait for a crisis if we want to prevent them. That is why we must take concrete steps now. European legislation should ensure that such schemes cannot operate in the EU unless they're supported by robust equivalence regimes in other jurisdictions and safeguards relating to the transfer of assets between the EU and non-EU entities, be they headquartered in some island. This also highlights why international cooperation is indispensable. Without a level global playing field, risks will always seek the path of less resistance. So, let me take you back to the submarine. Like all good submariners, you have to go back to the surface. We have to go back to the surface. And this is a moment where all together we can go back to the surface, compare notes, exchange views, draw on each other's talent and competence to better understand what is our next dive and what kind of signals we are likely to hear. With that, I wish all of you a very good conference, and I encourage you to think about this journey of the submarine and how cutting the noise from the signal is critically important. Thank you so much.